Welcome to this webinar on SAP Business One Fixed Assets. My name is Ketan Solanki, and for the next hour, we're going to go through the following agenda. We're going to have a bit of an intro on fixed assets. Then we're going to go through the various retirement methods that are available for posting, look at the GL determination, look at the depreciation areas and the types, the asset classes and the asset master data, the acquisition process, the retirement process, how depreciation works, and some other transactions. And then finally, we'll be looking at how to bring across the balances for the assets. So before we go into the application itself, let me just give a bit of definition in relation to fixed assets. So fixed assets basically is a long-term tangible piece of property that a company owns and or leases, which will be held in production of its income and is not expected to be consumed or converted into cash any sooner than at least 1 year's time. So it obviously means that it cannot be debtors or inventory and so on. It's got to be something that's held for a longer term. Fixed assets can be referred to as property, plant, and equipment. So that's one part of the equation. The other part of the equation, obviously, is depreciation. And depreciation essentially is the decline in the value of an asset due to its use and the allocation of the tangible assets to periods in which the assets were used. So fixed assets has been part of the SAP core system since version 9.0, and now with that, what that means is that you can use the SAP marketing documents such as purchasing and sales documents to acquire the asset as well as sell it. And what it also means is that you can drill back from the journals to the source transaction and vice versa. Now, this was not available when fixed assets was just an add-on. So pre 9.0, fixed assets was an add-on, and at that time you could not drill back to the source transaction. So the opening balances of a fixed assets, if you are deploying fixed assets, the opening balances need to be imported as at the beginning of a financial year. So you cannot do a cutover and bring balances in the middle of a financial year. You can cut over at any point, but then what you have to do is bring the balances at the beginning and then run depreciations and do a reconciliation on what you've already posted. So the ideal time, if your financial year is July to June, is to the deployment in the month of July. So if you're currently running fixed assets on a version prior to 9.0, and so which means that you're running the add-on, what it means is that if you upgrade in the middle of a year, you can continue to use the add-on. There's a version of the add-on for 9.0 or 9.0 plus, and you could continue to run that add-on until the end of that financial year, after which the system will force you to change to the standard core functionality. There is a fixed assets migration tool available for those who are running the add-on and are going to convert, and that basically takes the balances at the end of the previous financial year and converts them into the new database and table structures. We will not be looking at this migration tool today, but just keep in mind that when the migration tool is used, the history of the transactions that happened in the previous version or the add-on version do not get brought across. Only the balances or the net book value. I mean, it will show you the acquisition value and the depreciated amounts, but you will not have any history of the transactions. Those will still remain in the old tables, so you can get at them, but you would not be able to use the standard screens in SAP to look at them. Okay, so that covers just some of the background and information. Let's now start looking at the system. So firstly, to activate the fixed assets, you go into administration, system initialization, company details, and then in the basic initialization tab, there's a checkbox that says enable fixed assets. Once you tick this, there's another setting that you need to do or decide on, which is whether you wish to have your depreciation calculated by month or you wish to do it on a daily basis. What this means is that if you choose month, then the amount of depreciation for each month of a year is the same. And if you choose daily or day, then what happens is the system calculates depreciation on a daily basis, and months that have 31 days will then end up having a greater amount of depreciation compared to months that have 28 days. So that's the setting to activate the asset module. For those who would have been running fixed assets in the prior versions as an add-on, you would also know that there is a numbering sequence, a numbering series that you can define. So in 9.0, in the core system, the asset master data actually shares the numbering sequence with the item master. In fact, the asset master looks exactly like the item master. So if you were to define numbering sequences for asset master, what you'd do is you'd go into administration, system initialization, and document numbering, and you just define a sequence for different asset classes. So if you had, let's say, 5 asset classes and you want to have a different numbering sequence for them, you just set up 5 different numbering sequences for those. The other transactions relating to fixed assets also have their own numbering sequence, and you can define those separately. So if you're doing a retirement transaction, then you can have that separate. If you were doing a capitalization transaction, you could define the start number for those as well. Okay, so from there, we've got to now define the GL setup. So that's found under administration, setup, financials, fixed assets, and then account determination. So there's a series of accounts that you need to define, and these accounts then dictate the postings that result from the various fixed asset related transactions that you do. So we're going to have a look at one of these just so that we can understand a bit more about what all these accounts are. So the first one you need to define is the asset balance sheet account, and this basically is the asset account in the chart for your asset. So whenever you do a acquisition, this is the account that gets debited, or if you're doing the retirement, then this is the account that gets credited. You also need to define a acquisition clearing account, and as the name suggests, this is a clearing account, and this is the account that's used if you were doing when you're doing an acquisition and you did not have a supplier. So what would happen is your clearing account would get credited and the asset account would get debited. And it's also the account that's used if you were using an AP type transaction for the acquisition. So in that case, this account is used as a clearing account as well. You have the revaluation reserve and revaluation clearing account. So where you decide to revalue an asset, so for example, you have a piece of land and the value has gone up, and you wish to display that or recognize that in your books, then the revaluation reserve account is the account that gets debited for the increase of the asset value. So instead of going against the balance sheet account, you have the asset balance sheet account, it goes into the revaluation reserve. And then the other side, being the credit, you would put into somewhere in your profit and loss area to define the increase, the profit you've made on that asset. Then you have the depreciation related accounts. So the ordinary depreciation is your depreciation expense. So when you run your depreciation, that's the account getting debited. The accumulated depreciation account is the account that gets credited, and this typically sits right next to the asset account, so that you can see what the net book value or the net value of the asset is, including the depreciation to date. The system also allows you to do unplanned and special depreciation, and you can post these to different accounts if you need to, and you could have also different accumulated depreciation accounts for these. The next set of accounts are all related to the retirement process. So whether you have a retirement with a sale or just a scrapping, you can define a bunch of GL accounts, and it's probably best to have a look at the impact of these accounts by doing some experimentation and see what works best in terms of what you're expecting the system to do. Note that there is two options here. There's a net option and a gross option, and depending on some other settings, the system will decide to use different accounts. But now we're going to have a look at depreciation areas. So this is what allows you to define where which of the areas is going to post into the general ledger. So you by default need to have one depreciation area for the posting to the GL. So in here we call it the book area, and it's type posting to GL. You can have other areas as well. So for example, you might have a different way of calculating your depreciation for tax purposes. Then you define a separate area for that. Now the one, as soon as you choose one that says posting to GL and is the book area, then what happens is there's additional settings available which allow you to define whether the posting of the depreciation is direct or indirect. And what that means is if you choose indirect posting, then the credit side of the depreciation run gets posted to the accumulated depreciation account, whereas if you choose direct, then the credit side goes straight into the asset balance sheet account. Now, in Australia, most people would be using indirect because you'd want to see separate accumulated depreciation account. And then you have the posting of the retirement, which we looked at before in the GL determination, and you can choose whether you want to have the gross method or the net method. Now, the other thing that also happens is that when you define your main area that posts to the GL, by default the system also defines an additional area called a derived area. And the purpose of this is so that if you wanted to do some what-if type scenarios, so if you wanted to do some special depreciation or revaluation, those sorts of transaction, you can do that in the derived area to see what the impact that has on the asset itself. So apart from those special types of transactions, the derived area exactly mimics the main area in terms of the depreciation methods, the useful life, and so on. And we'll see that a bit later on when we look at an asset. So that's the derived area. Then you can also have an additional area for your tax purposes, and this will all become clear when we have a look at asset classes. So now let's have a look at the depreciation types. And in SAP, the following methods are available. So you could have the option of no depreciation, meaning that you define the asset, you can acquire it, but there's no depreciation going on. You can have straight line depreciation, and so if you select the options straight line depreciation, then in the calculation tab you get further options. So the system's now asking you, what is the calculation for the straight line? Is it acquisition value over the total useful life? Is it the percentage of acquisition value? So you just can define a fixed percentage that gets depreciated every year. Or is it the net book value over remaining life? So when you are migrating your assets to SAP, it's probably important to consider which of these is the most appropriate for the assets that you're bringing across, which may be different from any further acquisitions or new assets that you have within SAP once you've gone live with it. So straight lines obviously a very common method here. There is also another option which is straight line period control, and it sort of follows this straight line method with some additional options of having some factors. So you might have an additional factor on top of the straight line calculation. Plus, you can also then define a different factor year by year. And so, this is not a very common method, but if you had some unusual depreciation calculations, then this might be a good fit. But I haven't really seen this one in use much in Australia. Declining balance. So this is where you define, it's like the what you also term as diminishing balance, where you define a fixed percentage. And so what happens is every year it depreciates that percentage off the net book value of the asset. And so, as you can observe that if you are always multiplying by a fixed percentage, then the asset would never go back to zero. But to allow for if you had that need to go to zero for an asset, then you can also have this automatic change to, where you can say, well, once it gets to a certain point, I can change my depreciation back to straight line. And then what happens is the system will calculate, is the diminishing balance calculated depreciation higher than the straight line? In that case, it will use straight line. If it is less than straight line, then it will change itself automatically. I don't think you'd be using this in Australia, so if you don't want to change it, then you leave it blank. Then you have this concept of a factor, and this is to allow you to define an upper limit on the depreciation amount. So if you didn't want to have an upper limit, then you'd make this number really large, so that your diminishing calculation is never higher than this calculated depreciation. But there is a calculation that is used to work out what the upper limit should be based on the factor. Then you have multi-level, where you can sort of define a different percentage depreciation year on year. You can have immediate write-off, where the asset just gets written off on acquisition. You can have special depreciation. Again, it's sort of similar to the multi-level, where you can have different depreciations month by month, or sorry, year by year. And then you have a manual depreciation option as well, where the system will not calculate the depreciation for you. You manually post the depreciation each month. So let's now come back to the general tab of the depreciation types. So here you can also define some other things. The first is the depreciation calculation method, yearly or monthly. And typically you'll be using yearly. do you want to have a remaining book value at the end of that financial period, or at the end of the useful life of the asset? And this is just a dollar amount. And you can also define a remaining value based on a percentage. And if you've defined a value in both of these fields, then the system would, the hierarchy is that it'll check the salvage value percentage first, and that overrides the remaining value. You can also define a maximum depreciation amount. I mean, these are probably all sort of very uncommonly used in Australia, but they are available. You can also say whether you want to round the year-end book value to be a full number. So instead of having decimals in the balance at the end of the year, you want to have a full amount, then you can tick this box. Then you have the depreciation conventions, and these can be defined for all the different types of transactions. So on acquisition, on subsequent acquisition, on retirement, and so on. And there's multiple options here as well. So you can have pro rata, and pro rata means do it on the basis of divided over the months or the days, or you could have some other options. But firstly, let's look at the pro rata. Once you define pro rata, then you've got some additional options here on the right side. And so it's either exact daily basis, which means that the depreciation, if you acquire in the middle of the month, then the depreciation will be for the remaining days of that month, for the first month anyway, and then from there on in, it'll do the whole month. Or you could say, whenever I've acquired it, start depreciating from first day of the current month. So even if I acquire something in the middle of May, do the depreciation for the whole month of May. Or you can say first day of the next month, so it will not do any depreciation for the current month, but it will start depreciating from June in this case. Take note that this is only applicable, these settings are only applicable if you're doing daily in the general setup. So in the initial company details area, if you've said month, then obviously these don't apply. But if you did say day, then they do apply. Then the other options you've got, first year convention. So this allows you to define that if the acquisition happened in the first half of the financial year, then start depreciating from the first day of the financial year. Or if the acquisition happened in the second half of the financial year, then start depreciating from the first day of the second half. So in Australia, that means that if the depreciation, if the acquisition happened between July and December, start depreciating from 1st of July. And if the acquisition happened between January and June, then start depreciating from June. Start depreciating from January. That's first year convention. Then you have half year, which means that it doesn't matter when the acquisition happened, start from the middle of the year. So only depreciate from the second half of the year. And then you have full year. And in that case, it will do the whole year, even though you might have acquired from the middle of the year. So do note that once you pick one of these options that isn't pro rata, then the temporis type disappears. It's just, it basically does the whole month. Okay, so that's the depreciation types set up. Now let's have a look at the asset classes. So again, under the setup, financials, fixed assets, asset classes. So here you can define the asset class, and then the main depreciation area, the one that does the posting, you've got to link it to the account determination. So if in your business you've got in the chart of accounts, let's say, a separate GL account for, let's say, motor vehicles by department. So for, say, motor vehicles in New South Wales, motor vehicles in Victoria, motor vehicles in Queensland, then you'd have 3 separate asset classes, and you'd also have 3 separate account determinations so that you can link the assets to the appropriate accounts. So the main area then is the only area where you can define the GL determination, and then you also define the depreciation type and the default useful life. So these are just defaults. So when you're doing an creation of a new asset master, at that point you can then also change this, but these are the ones that will flow through. You can also see that the derived area, there is no option for account determination to be changed because it's not posting to the GL, and you cannot change the depreciation type or the useful life either. They just follow whatever is on the main area. So if I change the useful life here to 60, then automatically the derived area also changes. It just follows whatever is on the main area. And then you have a tax area, and the tax area could have a different depreciation type and a different useful life as well. So this basically, the asset class basically links all the other settings that we've previously done together. And then that's in turn used when you create a new asset. So that's where we're going next. Let's now look at the asset master data. So once you've activated fixed assets under financials, there'll be a new menu item called fixed assets. And then in there, there's an option here called asset master data. And you open it up, and as you can see, it looks exactly like an item master with an additional tab called fixed assets. And there are obviously some additional options within that. So what I'm going to do is firstly open up an existing asset that I've got. So what you'll notice is that the fixed asset cannot be a stocked item, firstly. By default, when you create a new fixed asset, it will be tagged as a purchased item. But if later on, if you wish to dispose of that item, then you can also make it a sales item. You have for the status of the asset, in this case, it's still active because I'm still using it, I'm depreciating it. I've linked it to an asset class, and note you cannot change the asset class of an asset. You can also define some other categorizations and information, and all of these other settings here are all information purpose only. They do not drive any of the functionality or GL posting. So you could use these additional fields from a reporting perspective. So for example, if you got the stock number, in which you could enter in your car rego, for example. Serial number could be the VIN number of the car. And so depending on the asset, you could use these fields for different purposes. The location you can define as well. So where is it currently? You can also allocate it to a technician. So you can say, well, it's with this technician, as well as assigning it to an employee. So if you've given the car to an employee, then you could assign it to that employee. On the right side here, you can see you can select the different areas, depreciation areas, and you can also see the initial acquisition value, the net book value of the asset, and the ordinary depreciation to date. Now, note these figures that you see on this screen are based on what the position of that asset would be at the end of the current financial year. If you go and further down here, you can see the depreciation areas that are active for this asset and the depreciation type that's applicable. Okay, so we've got a start depreciation date and depreciation date and the useful lives and so on. And when you're creating a new one, you can actually change these parameters. Go into the value tab, and here you can see what the original acquisition value of the asset was, what the net book value of this asset was at the beginning of the financial year that we've selected, so we were looking at 2017. Then we can see all the other types of transactions that may have happened. We can see that, you know, the depreciation, ordinary depreciation to date, that's or the planned depreciation rather to date for this financial year, and the net book value that is expected at the end of this financial year. If I went back to the sorry, if I continue and go into the depreciation tab, then I can see the planned depreciation month by month, as well as what's been posted to date. So you can see that no postings were done in this case, the first and the second period, but in the third period, it's picked up and depreciated for all the first 3 periods of the year. You also have the cost accounting tab where you can define, you know, how the depreciation affects various projects and cost centers, and you also can have additional attributes relating to the asset. So what we'll do now is look at creating a new one and then take that through the acquisition process. So I'm going to create an asset, calling it a car. I'm going to tick the sales item tab as well. And then if I go into the fixed assets tab, I can assign it a asset class. And as soon as I assign the asset class, you'll see that it's worked out or pulled the default depreciation areas and the depreciation types for that asset class. I'll assign it to the motor vehicle group, and I'll put in the rego and the VIN number. And at this point, that's really all I need to do. And if I add that away, and then when I come back to it, I can see that I've got the asset here. There aren't any values against it, and there is no information in any of the tabs yet because I have not acquired it. So acquisition. So fixed assets acquisition can be done in 2 ways. You could either go in and raise a capitalization transaction, so straight on the fixed assets and capitalization, and then in there enter the asset master that you've created, and then you can enter an amount in there and quantity. So if you wish to track quantities on an asset, then you can enter the quantity in, or you could just leave it blank if it was just a single piece that could never be split. So the good example of where you possibly could use quantities is if you had, let's say, purchased a set of chairs, and so there are 6 in the set, and they're all exactly the same, and you just want to have one asset master for all 6 chairs, then you'd set it up and say there's a quantity of 6. And then what would happen is then you could track those, and you could then retire or sell one of those quantities if you needed to. So what will happen is if I post this capitalization transaction, basically it's going to credit the asset clearing account, and it's going to debit the actual asset account. So, I mean, with the knowledge that later on you're going to either get an invoice for the actual vehicle, or you might have already got the invoice for the vehicle, and you have already posted the AP invoice against the clearing account. So this would be probably useful where you might be building an asset and it's an asset in progress and you haven't really capitalized it. Then you'd come here and do the capitalization transaction to then create it. The other option is that you've got the invoice from the supplier and you can then enter the AP invoice for it. Now, you can go through the full purchase process with the asset. You raise a purchase order, do a goods receipt, and then convert that into an AP invoice. But you could also just go straight to, and what we'll do today is just go straight to the AP invoice, pick the supplier, and then simply enter in the item. So the AP or all the marketing document screens recognize the fixed assets in just the same way as they recognize items. So I can put a quantity in if I wanted to. So the chairs example, I put in the acquisition value. Now, if I do want to track the quantities, so I would have to tick this box. So again, the chairs example, if I had put a 6 in the quantity field, then I would also have to tick this box to ensure that the system, the fixed assets register, is tracking these as separate quantities. And so this is a new column that is available on all the AP documents, and you'd have to use form settings to add it if you didn't have it. So from here, I hit the add button. Sorry, I need to put a date in. And then I hit the add button, and the acquisition happens. And in the background, if I go into the journal entry, so the first journal entry is crediting the supplier and debiting the capital works in progress. But automatically in the background, a second journal entry would have been created for the acquisition transaction, as you can see, clearing the capital works in progress and putting it against the motor vehicle. And I can go in and look at this transaction that was automatically created in the back end. I think if you also did the relationship map, you could also see that AP transaction has a link to capitalization transaction. So now if I go back into the asset, I can see there is a depreciation capitalization date, a depreciation start date, and some figures in here in the values tab, as well as in the depreciation tab. I can see there's some planned amounts now for all the subsequent months. Remember, my setting is monthly, so it is calculating for the full month. Okay, so now that I've done the acquisition, I can run some depreciation. So to run the depreciation, I go into financials, fixed assets, and depreciation run. And you can select the period to which the depreciation needs to be done. That's just a selection area. Note that you do need to do the depreciation by area. So if you've got multiple depreciation areas, the main area, the tax area, the derived area, you need to depreciate those separately. So if I click on the preview button, the system's showing me all the assets that are in the system that need to be depreciated. And if I'm happy with what it's presenting to me, I can simply click the execute button, it's asking me whether I wish to run that depreciation. If I agree, it does it for me, and then I can also see a drill down back into the journals that were created, and you can also see that on the journal that's created, there's a drill down back into depreciation. Okay, so as simple as that. That's done the postings for the depreciation for us. So there are obviously other transactions, manual depreciation, if you want some extraordinary depreciation happening. Also note here that you can also do a credit memo. So if you've done a capitalization and there was a problem with it, then you just do a capitalization credit memo, which would be similar to converting an AP invoice into an AP credit. Let's have a look at now the retirement process. So very similar to the acquisition process. The retirement process can be done through the sales side. If it's a retirement with a customer, or if it was a direct scrapping, then you just pick the scrapping option, pick the asset, and simply add that away, and the scrapping would happen. So if I look at the journal that happens, it basically reverses out the acquisition, the accumulated depreciations posted, and then eventually you get a loss or gain. Well, in this case, it's always a loss because you're writing off the asset. You'll have a loss from the disposal of the asset. Now, if you do a scrapping or it's a sale, so there's a customer involved, then you also need to say how much you're selling it for. So keep in mind, this was an asset that we acquired for $45,000 and we had depreciated $750. If we look at the journal that's going to happen, we can see that again, there's the retirement and basically the net of all these transactions is the loss on the sale of the asset. So as I suggested before, you can do the retirement or the sale from here, but obviously then you've got a balance left in the clearing account because you've done a sale, then you've got to clear it off, and that goes into the retirement clearing account. But if you wanted to just use sales account, a sales transaction, you can also do that. So I can raise an AP invoice, AR invoice. I can pick a customer. I can enter the asset. I can put a price in, and I can add that away. And again, then in this case, it will be a two-step transaction. If I open up the relationship map, I can see there's an AR invoice and then a retirement transaction. If I look at the journals, the first journal is just doing the revenue part because I said I'm selling it for $30,000. It's just posted that. And then in the second one, it then takes it out of there and then does all the calculations to define whether there was a gain or a loss. If I come back to the asset now and look at it, I can also see that it's now inactive because we've retired it. And if I go into the values tab, I can see what's happened on that transaction. You can also do a right click on any asset master and look at the asset transaction report that shows you all the things that have happened against that asset. So just having a look at some of the other transactions now. So first one we can have a quick look at is the asset revaluation. So this transaction can only be done at the beginning of a financial year, but effectively you pick the asset and you can then say, well, I'm increasing it by a certain percentage, or you could just put a new valuation, and then there'll be a journal entry behind the scenes for this. But as I mentioned earlier, you can only do it at the beginning of the year. You can also do a transfer. So this is useful where your asset is moving from one class to another, so the GL setup is different. Example is that, you know, how you have a car and the car is now being transferred from New South Wales to Victoria. Then you'd have a, you can do a transfer transaction. And if you have a quick look at this, if you look at the journal entry, you'll see that it's moving it in this. I mean, it's not the perfect example because the classes are changing from motor vehicle to buildings, but you can see what this would do for you. Okay. So the final process in fixed assets in terms of, you know, your operations is the fiscal year change. So what happens is at the end of the financial year, once you've done all your acquisitions, once you've done all your retirements, all the depreciation, you've got to do a rollover. And when you do the rollover, what happens is the system then calculates the depreciations for the new financial year. Okay, so if you don't do a rollover, then if you go into the new financial year, you won't see any calculated depreciations in the system at all. There are a bunch of reports as well in the system that give you, you know, the expected forecast depreciation for the year, and, you know, based on the calculations in the system, what would the position be at the end of the year. You also have the asset history sheet, which shows you what has been posted to date, including what was the balance at the beginning of the year and all the different types of transactions that happened relating to the asset. So then the final topic we have is the actual fixed assets cutover process. So this basically, what you, as I mentioned earlier, you have to do it at the beginning of a financial year, and the process to setting it up is, firstly, you've got to do all the back-end setup, including all your asset classes, your depreciation areas, and so on. And once you've done those, you have to bring the balances in via Excel. Just a word of caution, there is no way of reversing out assets that have been imported through the migration process. So you must do the initial import in a test database, confirm all the figures are correct before you put them into the live system. Because if you just import them straight into the live system and they're not correct, then there's no way of reversing that out. Okay, so very, very important that you do it in the test system first. In fact, you should you know, contact your consultant and just and discuss you know, what you're planning to do before you get started with it. You know, it's coming up to 1st of July, so this is the perfect time to do it. But do consult before you go off and do it yourself, because there are some traps. Okay, so I'm just going to bring up the template that you need to use for importing the asset. Okay, so the example that I've got here is I've got basically in my case, I've got 3 different depreciation areas: main area, additional area, and derived area. And so for each asset that I'm trying to import, I need to have 3 lines. So it's the same asset repeated 3 times because I have 3 areas. I have the capitalization date, I have the asset class, and then I have the start of the depreciation, the useful life, the remaining useful life, the depreciation type. Now, very important when you're importing this, the depreciation start date needs to line up with the remaining useful life. Otherwise, the import process will reject it. So if it finds that you started depreciating on a particular date, and a certain number of months have passed since and you're doing the cutover, and if the remaining useful life doesn't line up with that, then it'll error out. You put in the initial acquisition value, you put in the accumulated depreciation to date, and then basically once that file is prepared, you need to save it as a tab delimited file without any headers. And then back in SAP, you go through administration, data import, and import fixed assets master data from Microsoft Excel. And then in here, make sure that you line the columns that are in your Excel spreadsheet back to this, and you run the import process. And the system will import any assets that can be imported successfully, and it will fail on the ones that have an issue in terms of dates or whatever it may be. So again, very important that you do this in the test database first.